Welcome back everyone to the Moneycontrol live stream. You are watching Markets with Santo and CJ. Well, as expected, the market is down and out at this point of time. The sell-off has only gotten worse with foreign institutional investors obviously driving the sell-off at this point of time. Globally, markets have been giving us negative cues from Europe to Asia to New York. We have seen negativity across the markets. If you look at the Nifty and Sensex at this point of time, they are headed for their 6th negative closing in 7 sessions at this point of time. It's IT, banks and metals who are leading the sell-off on the Wall Street at this juncture. And if you look at the volatility gauge, India VIX, that itself has also inched higher as uncertainty rises ahead of that key crucial inflation data in the US later in the evening. Plus, of course, do not forget that China, again, there are murmurs of lockdowns again in China. So that is again a big blow to the global economic sentiment. So that is, I mean, a lot of negativity out there, Santo, and it seems like it is broad-based.
Well, CJ, if you notice, market has now fallen for 6 out of the last 7 sessions, and it's still not fallen below the lows touched a fortnight back. So now this clearly indicates that the bear market is getting very treacherous. In the sense, previous to that, you had very sharp up moves and down moves. Here now, the market is falling, there is a pullback, and then it slowly keeps sliding down. It's not just one very sharp down. So it's keeping,
it's a grind. It's a
grind, and that's keeping investors on the tenterhook. It's very confusing whether to buy or sell, because it's giving chance to neither. So this is going to be one really slow grind, and I think, CJ, we should be in it for the long haul now.
I hope you are wrong, Santo. I really do. That said, a lot of stock action at this point of time in the market. Starting off with Santo, Purvankara, a real estate firm. Now, this is a company that saw record sales in FY22. I mean, quite a spectacular earnings year for the company, led by the improvement in the residential business. Now, that has resulted in a lot of confidence in the FY23 numbers as well. The management had indicated that the demand scenario will remain quite positive, Santo, even though, I mean, there are question marks around the inflation environment, interest rates rising, home loan rates rising, but they feel that home loan rates are still not at the level wherein it could hurt demand for residential real estate. Apart from that, if you look at the launch pipeline of the company, that itself is quite robust. After a very, very long time, the company is now indicating that they could be launching projects to the tune of 12 million square feet in FY23. In addition to that, in FY24 and FY25 as well, they see a good runway for project launches. So clearly, inventory has been taken care of. I mean, the slowdown that we had seen in the real estate market over the past 6 to 7 years, that is clearly now in the rear view mirror for real estate companies. And Purvankara, being one of the smaller cap players in the real estate space, clearly has valuations as well as growth in its favor given the small base.
Well, CJ, all those points are taken. However, you see, I was just having a look at the graph. The stock has fallen very sharply from Jan. In fact, at a time when most real estate companies, in fact, have done well. That's I fail to understand. If it's doing so well,
it is across real estate, Santo. I don't think Purvankara. You can single out Purvankara.
But there's almost a 60% drop, which
is
like
I mean,
huge.
You look at other stocks as well in the realty space. Ever since that emergency rate hike happened, some of the realty companies have taken 20-30% cuts on average. So clearly, market is fearful that rising home loans will result in slower demand. But the management, on the other hand, if you look at some of the post-earnings commentary that has come in, even after the rate hike happened in May, they remain quite hopeful that, I mean, this will not probably result in a demand destruction that the market is fearing, Santo.
I still feel, CJ, that the market seems to be on to something, because the stock price fall is clearly indicating that. It's a much steeper fall compared to any other real estate. None of the others have fallen so much, over 60%. So, and also, if you probably look at the 1-year sales, it's still very low compared to the good numbers that you've seen for most companies. So the pipeline, I take the point, the pipeline may be good, but at this point, given that rates are rising and there is a lot of uncertainty in the air, I guess overall real estate stocks could perhaps struggle a bit.
Well, I doubt that, Santo. I feel that probably once this near-term sentiment, dampener is out of the way, probably you will start seeing the buoyancy come back, because the first quarter, maybe the second quarter earnings will reflect the strength or the management point of view, and maybe the market will also come around.
Well, the stock that I have on my watch list is AU Small Finance Bank, now small sized NBFC, and it's done pretty decently in the fourth quarter, and it's got a largely secured book with almost 76% of it coming from the retail, and it's managed to expand its net interest margin. That was largely due to doubling of its current account, savings account, deposit base, and Moneycontrol Pro has a bullish note on the stock. And the overall the key thing about this company is that it is catering mainly to SMEs, auto, and mortgage segments. So the SME, all three segments have done pretty well during the fourth quarter. Now going forward, there is some concern given that you're looking at a slowdown. But if you were to pick a stock among NBFCs, then this probably could be one that should be able to weather it better, given that it's got a improving asset quality, and that it's managed to bring down its cost of funding as well.
Well, Santo asset quality stories and re-ratings on the basis of asset quality improvement is just 2021, no longer 2022. If you look at the valuation of the bank at more than five times 1 year forward book, it's clearly very, very rich at this point of time compared to many of the private sector lenders out there in the market who are much bigger in size and have a bigger portfolio on the loan side as well. Apart from that, basically based on the technical factors as well, if you look at the daily and weekly charts of AU Small Finance Bank, that is at this point of time screaming sell. Or most of the near term or short term moving averages are well below their long term moving averages, and clearly there is a lot of selling momentum in the stock. So for me, probably not the best time to get into a stock like AU Small Finance Bank. I rather shift my focus to stocks that I am rather have more conviction on than to take a punt on AU Small Finance Bank. That said, one stock that is looking quite good in the overall market so far this year is West Coast Paper Mills. Now, paper story has been one of those themes that have remained intact despite the sort of negativity we have across the market. The stock has risen about 43% in 2022, largely on the back of a very strong earnings performance as well as outlook. If you look at the global pulp prices, they have been largely buoyant throughout of 2021 and 2022 because there is less supply available and demand has been rising, especially led by the e-commerce segment. You have your e-commerce retailers who have also been using paper in packaging products as well. So therefore demand clearly is outpacing supply, and prices therefore remain quite buoyant, and it's reflecting in the earnings performance of a company like West Coast Paper. Now, rating agency India Ratings recently came out with an upgrade on the outlook for the company's debt profile. They believe that the overall improvement in earnings, the balance sheet, as well as the industry dynamics clearly make the stock a favorable, make outlook on the stock quite favorable at this juncture. And demand prospects also remain quite good and stable in the medium term according to India Ratings. So clearly, one stock probably where you have earnings growth, Santo, and valuations also are actually not that expensive. So a win-win for me.
Well, CJ, the valuation part has to do with the fact that it's more of a cyclical play. Every time pulp prices go up, the stock sees a run up. But just look at the longer term chart of that. This is a stock where you need to catch the tide, correctly.
Thank God I did that.
Okay, so if you're playing the momentum there, I would say get off at the right time, because once the cycle turns, then for a long time you'll be just left holding that stock.
But for me, right now is not the time to get off. So that is why I would still suggest there is a lot of upside. As long as the pulp prices remain good, I feel earnings for West Coast will remain strong going ahead, and for much of the other paper stocks as well, not just West Coast. And probably, as you mentioned, if you want to get off that ride, the only time will be when you start seeing pulp prices globally roll over and you see more supply coming in the global industry.
Well, in the market, you really can't wait, for the tide to completely turn.
No, you can always wait for announcements, right?
Well, a quick look at the market before we continue with the rest of our stocks still continuing to be under pressure at this point. The Sensex is down by about still around 900 odd points under pressure.
Yeah, I mean, the market is around a day's low at this point of time, a little off the lows, but still down and out. You have the Nifty index down about 1.6%, whereas the Nifty Mid Cap 100 and Nifty Small Cap 100 are the two indices which have seen a decent recovery. They are down 0.8 and 1% respectively at this point of time. Whereas the India VIX has clearly taken a bump higher. The index is now higher by 2%. It was earlier hovering around the 1.4 to 1.5% mark. So clearly uncertainty is rising as we're heading towards the close, Santo.
Well, this thing about mid-caps doing well still seems to indicate that retail and HNIs are very hopeful about a bounce in the market. Now, I don't know whether it's better, for the better or worse.
I told you it's for the better. Next stock, Santo.
Larsen and Toubro, decent guidance, but at that time, many, including CJ, was quite disappointed with that numbers. But now the key thing is whether that is achievable or not. But according to brokerages tracking the stock, this is clearly achievable. According to Jefferies, which had a meeting with the management some days back and come out with a report, it said that the company is fairly hopeful of being able to meet that guidance. And
the company is always going to say it is hopeful, right? It will never say that, yeah, we will.
No,
or we will not.
Not necessarily, CJ. At least not, a blue chip company like Larsen and Toubro, I would say. And Nomura says that, again, the company has said that there's been no delay from the government so far on its project, and also the company expects the capex momentum to continue. It's also counting on some improvement in the revival in near-term private capex. So all that puts L&T in a good position, given that clearly there will be a preference for the tried and tested names in this market, CJ.
Well, Santo, I don't know about that confidence that L&T probably might be projecting to brokerages that it is meeting. If you look at generally in economics, when there are times of high inflationary periods, government's action will shift towards ensuring that the consumer suffers as less as possible, and clearly subsidy bills tend to rise in that juncture, and that will, of course, you will have to balance the book somewhere, right? So if subsidies are rising, infrastructure spending tends to suffer, and that is something that L&T itself indicated to analysts at Nomura Securities. They said that during high oil price environments, it results in a lower spending on the infrastructure side. That said, of course, they said, of course, if the government's tax revenues are more than what they are projecting, then that could be an upside. Apart from that, I feel that the order inflow guidance of about 15% for FY23 is something that I'm not convinced that the company can achieve it, until unless, of course, they end up getting humongous orders from Middle East countries where, because of higher oil prices, you could see more infrastructure capex happening. But at home, at this point of time, it looks very difficult given the uncertainty that we have around interest rates, around the macro environment. I don't think that private companies also will be so, rushing to write checks out for expansion of capacity or addition of new capacity. So for me, L&T remains on the watch list, but not something that I would be betting on at this point of time. Well, one stock I'll definitely not be betting at this one point of time is LIC of India. Now, the stock has had a pretty bad run since the time it has listed on May 17. It is down about 25% at this juncture from its issue price of about 949. Now, some analysts believe that going ahead, the stock could continue to see some technical selling going ahead and could drop below the 700 mark as well, which is quite crucial. Now, it is important to keep in mind that the lock-in period for its anchor investor, Santo, is also going to end on June 13th. So once that lock-in period ends, anchor investors will be free to sell their shares if they want to in the market. Now, majority of the anchor investors were domestic mutual funds. In the case of LIC, there was very little or negligible presence of foreign investors. So we will have to see if those fund managers stick to their true blue credentials of being value investors and probably end up buying more instead of selling. But clearly, if it ends up hitting their NAV, they might want to cut their losses. Apart from that, on the fundamental level as well, the outlook remains quite sluggish at this point of time for LIC, given that a lot of the brokerages are not convinced that the company can scale up its non-participatory protection business to the way the private sector rivals have been able to do that, and that they believe could end up hurting growth in the longer term. So for me, LIC is, at this point of time, is an avoid in my books.
Well, CJ, already the stock at the time of its IPO itself was fairly reasonably priced. It was hard to say that it was very expensive.
No, it was not expensive, definitely.
Right?
Definitely not.
It was not expensive, and now it's come off what, more than 20% from those levels already. It's only become even cheaper. Now, the sentiment for insurance stocks in general has changed over the last, particularly life insurance companies have changed over the last month or so. Strangely,
I think it's only private sector
private
companies,
sector, yes.
not LIC.
Yes, no, I'm saying for the overall life insurance sector, it has changed, but LIC has been an outlier there. It has not really participated in that despite being cheap. Now, LIC is trying to increase the share of its non-participatory products. You know. It definitely has to take them up, and that is one of the reasons probably the income revenues last year were not all that high, because it was sharing a lot of those, you know, its dividends with the policy holders. Now, that's set to change as it, you know, increases the share of non-participatory products in its portfolio. So, if you consider that as well, then we are looking at better earnings going forward. Considering the stock price fall and the fact that earnings are set to get better, I think one should be taking a more positive view on LIC here on.
Well, it's a big if Santo, they'll be able to scale up that non-participatory side of the business. If they can, then definitely it could be a big kicker for the stock going ahead. But if they fail to do so, or if the market gets a hint that they are not able to do it at the same pace as some of the private peers, then I feel that the sentiment could remain downbeat in the near term.
Well, moving on to our next segment now, rate hike by the European Central Bank looks imminent. They've already indicated to that, but there's also a lot of talk about fragmentation. It's not as simple as the US Federal Reserve hiking its rate. So CJ here is going to enlighten us about what this whole talk about fragmentation is. So
well,
CJ,
Santo, you know, so clearly the ECB has joined its brothers in the US Fed and other, you know, advanced economies in indicating that it's going to raise interest rates going ahead, and quite sharply. I mean, they're indicating a 50 basis point hike in September alone. They're going to stop the QE or quantitative easing from July onwards itself. Now, this had led to quite a sensational reaction in markets across Europe, especially in the bond market, Santo, because while German bond markets did sell off, but the major amount of sell off happened in the Italian bond market. Now, why is this happening? This is happening because Germany, which is more, you know, one of the best economies out there in the European Union, is expected to probably be able to handle, you know, the high interest rate better than the Italian economy, which is one of the weaker economies in the EU. Now, what is this fragmentation that you know, Santo is referring to? So the fragmentation is basically this difference in the movement of bond prices of Germany and Italy or other countries in the European Union. Now, this happens because EU has 19 countries, 19 governments, and therefore 19 different fiscal policies. But when it comes to monetary policy and the currency, it only has one. It only has the ECB as its monetary policy authority, and it has the euro as its currency. So whenever there is a different movement in bond yields and there is more pressure in certain countries' bonds than on other countries, this raises risk of financial instability and breakdown of the euro as a currency. Now, remember, if you can, you know, jog back your memory, this was a similar situation that happened back in 2011 and 12 when the European sovereign debt crisis was at its pomp, and that is when the famous quotes from then President of ECB, Mario Draghi, came that they will do whatever it takes to protect the euro's sovereignty. So clearly, this is one risk that is emerging at this point of time. There is, I mean, among economists at least, there is fear that we could be looking at a Greek debt crisis, sort of a crisis again, if the you know, the ECB does not step in to monitor some of these bond yield movements. But ECB, on the other hand, remains quite confident, Santo, that the situation is not yet as dire as probably it was during the depths of the pandemic or during the 2012 crisis.
Well, with that, what do we have on the horizon? What is there
Santo,
to look forward
the most important thing is the US inflation data for May later in the evening. Remember, this is just coming ahead of the monetary policy meeting next week of the US Federal Reserve. So clearly, if the data comes out to be worse than expected, it is going to result in a lot of, you know, uncertainty and jitteriness.
Already indications are there.
Yeah, I mean, the White House, there were reports in the US that White House expects the inflation numbers to be quite bad, given that a major chunk of the energy price movements resulting from the Russia-Ukraine war were felt during the month of May. Apart from that, of course, if you look at some of the private indicators, they are also indicating that the inflation number for May would be quite bad. Apart from that, of course, as I mentioned, the US Federal Reserve will be meeting next week to decide on this monetary policy. Now, the bets are that they will raise interest rates by another 50 basis points next week. So that is clearly out there. But if the inflation data turned out to be worse than expected, then that is where the uncertainty could come in, whether the Fed would be forced to hike by more than 50. Because remember, the US jobs data for May was very, very strong. It was much higher than what the market was expecting. So clearly that is one risk for next week. Apart from that, at home also a key data point, that is the May inflation, CPI inflation data will come out on Monday evening. Now, of course, we know that RBI has clearly indicated that rate hike movements will depend on how inflation is. Now, if you go by the rate hike that the RBI took of 50 basis points, clearly it suggests that they were aware that maybe the May numbers are also going to be quite bad. So that will be another important data to track.
Well, thank you for all those insights, CJ. With that, it's a wrap on this edition of Market with Santo and CJ. Thank you for watching, and please do share your feedback on the show in the comment section below.
Yes, do follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and the Moneycontrol app. We will catch you live again next week, morning 9 a.m.